Welcome to the Wall Street Truth Bombs weekly wrap. Let's look back at the key themes that impacted the markets and your portfolios. The market got hit with a rare double dose of dovish disappointment this week. A huge labor market flop and an inflation gauge that simply refuses to cool. Traders went from confidently pricing in next week's rate cut to trying to script the entire 2026 easing cycle. Meanwhile, the Treasury yield curve flattened out like a pancake at a high-stakes breakfast. The core problem, my friends, the Fed is still flying blind on a backlog of government shutdown data. And the latest private sector signals are screaming, slow down, but the price pressure just isn't listening. Now let's look back at those key themes of the past week. Let's start with one of my favorites, one that we have been covering an awful lot lately. In a lot of the videos that we've been putting out, in last week's recap, the week before's recap. Why? Because it's so important. And that, of course, is the ADP employment numbers. I feel like I have to remind everybody that we're still flying blind when it comes to labor numbers, right? Remember, government shutdown, the agency that is responsible to give us those timely numbers, that would be the Bureau of Labor Statistics. Bureau of Labor Statistics, or BLS, was shut down during the government shutdown, and they have not been delivering the important, timely employment numbers, right? They notably deliver the CPI and the monthly labor situation. That's, of course, where we get these. We get, of course, the unemployment rate, and we get the all-famous non-farm payrolls number. And that comes out once a month on the first Friday of each month. And we have not been in receipt of said since the shutdown. In fact, they did deliver one. They delivered a late one, which is a September labor number, which was positive for the labor market, but that was for September. We've not gotten October. In fact, October has been completely erased from the book, so we're not going to get that one. And now we're in December, and in this past week, we should have gotten the November number, but we haven't gotten it yet. That will probably come out in a delayed fashion. But the fact of the matter is that we don't have any official government data. But that's okay, because we have private numbers. And this week, and one of the most prominent ones, of course, comes from ADP. May I remind you, ADP is a payroll processor, the largest payroll processor in the country. They look across all of their clients' records. These are actual numbers. They look at job separations versus job additions. And they do the basic math. And they tell you how many people either were fired net or hired net in the past month. This is an old number. We've been watching this a lot. It comes out on the Wednesday, usually before the Friday of the official BLS report. Now, it gets a lot of heat because it's only looking at ADP's clients, but there's still a lot of clients out there. So it's a pretty good statistical sample. The challenge is that people like to look at actual numbers, right? And so, of course, it's not going to tell you the entire U.S. economy. It's just going to tell you how many people were net hired or fired out of ADP's clients. So it's important to understand that. And people who understand how statistics can actually look at that number and get an idea of what might be happening in the broader economy. So, of course, we don't have the actual number of people that were fired in the U.S., but we know, is it getting better? Is it getting worse? What's it looking like? Is it speeding up? Is it slowing down? These are important things. And that's why I watch the ADP number all the time. I don't look at it as a predictor of what's going to happen with the BLS number. The BLS number is the BLS number. The ADP number is the ADP number. And I put a lot of weight on the ADP number because it is not any statistical gymnastics. And unlike the BLS number, which is going to be revised in March of next year, the ADP number is what it is. It's an actual number. So have I really harped that one to death already? No. It's that important. Well, it's that much more important now because really it's the only number that we have. And now, and I know I've covered this before, but it is so important, I want you to remember it. ADP now puts out a weekly report, okay? It's their weekly pulse report. And the Pulse report actually gives you a more timely number. So they tell you over the last 4 weeks, what is the moving averages? What are the moving averages of the net additions or subtractions number? So you really know what's going on within the month, right? So we can actually get an idea of our hirings and our net firings slowing down, picking up. It's actually a fantastic number, and it doesn't get enough coverage just yet. But I can tell you that it will start getting a lot more coverage because it's that interesting of a pulse to literally a pulse, and that's what they call it. On the labor market. And we know leading up to this week, we had a couple of negative numbers in a row. We had a bad one, then we had a less bad one, and then we had a worse one. So it probably won't shock you to learn that in this past week, when we got the monthly number from ADP, the monthly number showed that there was a contraction of 32,000 jobs. That means there were 32,000 jobs net lost in the ADP universe, okay? Analysts were expecting we're expecting a gain of something like 10,000 jobs, but yet ADP came out and said we lost 32,000 jobs. Now, 32,000 jobs is not going to blow up the entire U.S. economy, but it does show you that there's a contraction, and it does show you that indeed the labor market is struggling. And this is a theme that I've been hammering home with you for the past several weeks, more than past several weeks, the last several months. And again, this is where we have to say, why do we care about the labor market? Well, we care about it for two reasons. The first reason we care about is for a real practical reason, right? Because GDP, right, our economic output in this country, it is very much dominated by consumption. Consumers, my favorite topic, and consumers having jobs or not fearing for their jobs is very important for confidence, right? And confident consumers consume, and when consumers consume, the economy grows. So, of course, having jobs is extremely important. It's at the core of the whole problem. And so if people are losing their jobs, we can expect that pretty soon that confidence will be lost, and we can expect soon that consumption will come down and GDP will also struggle a little bit. So that's number one. That's one important reason why we like to watch the labor market. The second reason, if you care about the Fed and interest rates, and pretty much everyone cares about it these days, the market is addicted to what the Fed is going to do. And the Fed has two primary jobs. It has a dual mandate. First part of its mandate is to focus on inflation. And we're going to be talking about that in a second. That's another key theme. But that's number one, keeping inflation in check. Number two, full employment. That means people, when you talk about full employment, that doesn't mean people losing jobs, right? It means adding jobs, right? That means low unemployment rates. That means adding, right? Adding. And so if jobs are going out, like ADP suggested, like the NER Pulse number over the past several weeks suggested, then the Fed should take note. And we know that there's a very big FOMC meeting next week. We're going to talk about that later on. And everybody would like to see the Fed cut interest rates in next week by 25 basis points. And in fact, as I said at the top of this video, people are already starting talking about how many cuts we're going to get in 2026. Well, I guess that makes sense. We are officially in December, the last month of the year. We only have a couple more weeks. So if you'd like to know what the Fed is thinking, what they're going to say, then we would hope that they're paying very close attention to this ADP job and to the NER Pulse numbers. That, of course, because they don't really have any other numbers to look at. But I'm not being completely honest with you on that. Now, we did in the past week start to get the weekly jobless claims numbers again. And those are interesting numbers as well, right? They report on a weekly basis, and that's an official government report. they actually tally all the state data to tell us how many people filed for first-time unemployment claims, and that gives you an idea of people who are recently laid off, right? Because it's a first-time claim, so we have a good idea of what's going on in the labor market. Last week's number came in a little bit better than expected. And that's positive for the labor market, but it's still significantly low. It's significantly high number, right? So it's still in the wrong region. It just didn't go up as fast as maybe analysts were expecting. So it was maybe a glimmer of good in a sea of bad. But we are getting those numbers every week. And I know that the Fed is certainly looking at those numbers as well. So that's the labor market and the ADP report. And that was a key theme of this past week. That brings me, I'm going to give you a bonus on that one. We had another number that nobody looks at, another private number. And that comes from Challenger Gray and Christmas. They're a separation HR type firm, right? So they specialize in folks that are getting laid off. And so in the past week, they came out with a number that was, again, that is a monthly number, and they basically show how many announced layoffs there were, because they check for layoff announcements, and the numbers were slightly better this month, but they were in the past month. So they just reported November, and November was better than the really, really bad October number, where there were a lot of layoffs announced. However, this November's number is still significantly higher than last November's number. So it's very clear that layoffs are being announced. Layoffs, whether you track month to month or whatever, the point is that so far this year, the amount that have been announced has been significantly higher than last year. So we know that there's pressure on the labor market. This is so obvious that it is embarrassing. If I ever hear some of these Fed governors, these FOMC members come out and say that they think the labor market is healthy, it may be not as bad as it could get. There's no question about that. However, if you want to track which way it's going, it's clearly going in the wrong direction. So the Fed should most likely take note, okay? And that is all I'm going to say for the moment on the labor market. Let's go to the other side of the Fed's mandate. We have the inflation, right? So Fed is responsible for maintaining inflation. Now we all know the inflation dialogue, the narrative around inflation is we still have sticky inflation. We know this, okay? And the Fed is always telling us about how they're so worried about inflation picking up. Well, guess what? This week we just got our PCE inflation number, right? PCE. Personal consumption expenditures. PCE inflation is the number that the Fed likes to watch. We talk about the CPI all the time. They look at that too. But the PCE calculated slightly different and from a different agency. And that number came out this week. But that number was from September. So we're getting old numbers at this point. But a number is a number. And so we did get the PCE number this week. It's an old one. And basically that number ticked up ever slightly, but it was right on analyst expectations. It ticked up month over month from August to September, if you can even remember that far back. But that's the key. But I like to look at that number when I look at that number, and I'll cover it in more depth when I do the look back of the economic numbers of the week. But you got to look at that number, and you've got to look at what we like to look at now, especially is not only for sticky inflation, but we like to look at the durable goods inflation, right? Because durable goods is where we would see if tariffs are having an impact on inflation. And we looked at those. And by the way, it's modest. And in fact, it probably ticked down a little bit. So, inflation did not finally kick in because of tariffs, as the Fed suggests, is the reason why they're being so stingy with the rate cuts. And so we got that. That was a key theme of last week. But before I go on, I want to remind you, if you like this kind of content, click like and subscribe, because we drop this stuff every day. In fact, some of the stuff that I just talked about before, we released those bomb blasts right as those numbers came out. And so if you clicked subscribe, you would get notified and you would know about those numbers probably before you heard about them anywhere else, because we watch that stuff extremely closely. So let's move on. What else happened this week? Another key theme is I would just characterize as rate cut certainty, right? So everyone's obsessed with whether or not the Fed's going to cut rates next week in their FOMC meeting. At the beginning of the week, we had almost a 100% probability of a 25 basis point rate cut from next week's FOMC meeting. And that agitated around a little bit. It went to maybe 95%, 97%. And it moved around based on the data, right? So every time we got a piece of data that we thought might push it in one direction. So, it moved around a little bit. There was also a lot of speculation on who is going to be the next FOMC chairman named by President Trump, which is going to be named after the new year. But, he can't keep a secret. So he's dropping all kinds of Easter eggs, and markets are speculating that it's going to be Hassett. And so there are people that believe he's not credible. Then there are people that believe he is credible. And we do know that if he ends up there and he does get confirmed, that of course he's going to be a uber dove, right? Because the president is very keen on having interest rates lower. I was fortunate to be interviewed by Bloomberg TV in this past week, and I sat down with a longtime veteran host Vonnie Quinn, and we talked about this very issue. She asked me what my thoughts were, whether Hassett will or will not impact the direction of interest rates, and my answer was it would be nice to believe that he would, but the answer is no, because I think the handwriting is on the wall. So no matter who's sitting in that corner office, I think I use those exact words. I think we're going to continue to see this downward cycle because of the point that I covered just a moment ago, which is the falling apart labor market. And so, whether Scott Bessent, because a lot of people would like to see Scott Bessent, the Treasury Secretary, there, but no, he's sticking to his job and maybe another one to pick up for Hassett if Hassett goes and becomes the new FOMC or the Fed chair. So you can see all the craziness, the nuances that are going around right now, because everyone would really like to know what's going on with the Fed. Well, let's talk about rate cut bets and what happened, okay? So rate cut, if you're increasing your probability for rate cut bets, you would see a movement in the front end of the yield curve, right? And so we're watching those very, very carefully. Those came down a little bit. Essentially, what you saw was, interestingly, you saw 10-year or longer yields come down a little bit in the past week. And so you did see a little bit of a curve flattening in this past week. But at this stage, curve flattening and curve steepening become important when you start to see them move at the extremes, right? But, it's something that we watch very, very carefully because interest rates have a lot of impacts. And that was another interesting theme of the week. But, I could keep you here all night long talking about these interesting themes, but I have to keep it basic. And it's very hard for me to keep it basic and short because there's just so much to talk about. In this past week, we also had this other interesting thing, which I call, the corporate sentiment split, right? So in this past week, we got some ISM numbers, which are purchasing managers indexes. It's like the corporate equivalent of the consumer sentiment numbers, right? But we want to know how how corporations are feeling, and we split them up into services, right, and also manufacturing. So, on the services side, the ISM came in and we saw that it was stronger than expected. And it just basically is showing that services economy remains resilient. And of course, and this is a continuing theme. It's not a new theme, but it was a theme that we looked at in this past week. And in this past week, we saw the manufacturing PMI also basically declined, unfortunately, sharply. So manufacturing continues to struggle, as we have seen. But this split, again, we have a very strong, not very strong, but we have a stronger services PMI. And those were some of the, sort of key themes that drove us next week. And so that there was the week where the market gave up on soft landing, I would say, and started pricing in what I would now call an emergency landing. The Fed is kind of between a rock and a hard place, right? And it's very clear, right? So we have slowing growth, and you see that in the labor numbers, and you have sticky inflation. So basically, it's all about decisions. And, the week ahead, we're going to find out what those decisions are. Join us every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.